And this year, I would characterize the difference in this industry being what is happening on the COMEX market.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And tonight, another roundtable on behalf of Miles Franklin and their Mugs and Medals series. So fortunately, they allowed us to rebroadcast that. So I might add tonight's episode, sponsored by Miles Franklin. If there is any gold or silver that you'd like to buy or sell, you can find out pricing information about that by emailing Yara at arcadia@milesfranklin.com. And with that said, to get into tonight's show, here you go.
Awesome. Thanks for joining us, everybody. What are we all drinking today? I got some, I have to confess, the only reason I bought this beer was it had the word gold on it. I got solid gold right here.
You got Deschutes Black Butt Porter.
It's Butte Porter, actually.
Well, it looks butt to me.
Great Lakes Brewing Company Christmas Ale here.
Drinking a red ale from, gosh, I don't remember it, but it's really good.
I've got a Woodner Hefeweizen.
Mondavi Merlot here. I prefer their Cabernet.
Fantastic. Well, you beat all of us in classiness, Lobbo. That's awesome. That's awesome. It's been a crazy year, and I'd like to just kind of unpack what's happened in 2020. We're nearing the end of the year. We're nearing Christmas and the holidays. So yeah, let's just take this time to unpack what we've all been through. I'd love to start with Andy, and my brother Kaiser Johnson is here. Kaiser, would you like to tell us a little bit about yourself and then introduce Andy?
Sure. I'm Kaiser Johnson. I'm Elijah's brother and Dunnigan's son. And I'm a voiceover actor out of Los Angeles. We just recently moved out of Arizona because Los Angeles is crazy. So, and 2020 was really crazy in Los Angeles. So that's a little bit about myself. And here's a little bit about Andy Schectman. He's the president and owner of Miles Franklin, a precious metals company that has eclipsed $5 billion in sales. Prior to starting Miles Franklin in 1989, Andy became a licensed financial planner specializing in Swiss franc investments and alternative investments.
Fantastic. Well, Andy, what I wanted to ask you today is, with all the changes we've seen in 2020, a lot of crazy things happening, but in particular with gold and silver, what do you think fundamentally has changed this year?
Sure. Well, first of all, I'm glad, very thankful that you're all here. And to me, the change in this industry or in this market has been a constant for the past 4 years. And prior to that, I can't think of anything over a dozen plus years that ever changed. It seemed to be more of the same, and very little changed in the precious metals industry. But over the last 4 years, I would characterize this industry as constantly changing. It started in 2017 with the central banks, in particular, the German Bundesbank, requesting their gold to be shipped home from the Bank of England and the New York Fed. Following suit were the Bank of Austria and the Bank of Hungary and the Bank of Poland and the Dutch National Bank, all of the European banks in 2017 requesting their gold to be shipped home. In 2018, the central banks went from net sellers the year before out of the clear blue, purchasing more gold than they did in the 60 years previously combined. And that was very unusual in 2018, a complete U-turn. In 2019, of course, we get the reclassification of gold as a tier 1 asset, which I have long maintained as being the most significant event of my 30-year career. And this year, I would characterize the difference in this industry being what is happening on the COMEX market. And it's very similar to what we saw in 2017 with the central banks requesting repatriation of their gold. This year, it's the subsection group called the others on the COMEX exchange that we classify as sovereign wealth funds, as family offices, and very high net worth individuals who seem to be requesting delivery at a massive, massive pace. In fact, every delivery month more so than we typically see in a given year. And this is what is fundamentally different this time or this year. It is the massive accumulation and taking metal off of the exchange and out of harm's way, following suit, I believe, to a pattern that we've seen for the last 4 years. And so I think it all follows a string of events that, have me believing that we haven't seen the end of some very significant moves in the precious metals market. When the most sophisticated traders on the globe start making changes that are fundamentally different like this, to me, I stand up and take notice. So I guess this year, Elijah, for me, the main difference upon everything that we've seen this year would have been the massive amount of gold being pulled off of the COMEX and what that means for prices and the market in general moving forward.
Well, thank you, Andy. We have a question here, Lobbo Tigre. And so let me introduce you real quick. Louis James Lobbo Tigre was legendary speculator Doug Casey's protege at Casey Research for almost 14 years until early 2018. He wrote in Casey's flagship newsletter, The International Speculator. Now he runs Louis James LLC, independentspeculator.com, to inform, educate, and enable action for an elite group of savvy investors and those who wish to become such.
What I'd like to ask you, Lobo, is essentially, how have things fundamentally changed with respect to gold and silver? And I know you actually recently wrote an article about this, how it's possible that because of all the COVID-19 stimulus that's been pushed through so fast, there's actually also going into 2021 a bearish case for gold. So if you want to lay out for our viewers that possibility, but then also the bullish case as well.
All right, well, 2 for the price of 1. And let me be absolutely clear. I am extremely bullish. And let's take the first question there, because that makes that case. And I would say, not to contradict my esteemed peer here who went first, but we look at things differently. And I don't really see a fundamental change. I see what I would call fundamental confirmation. Like we've seen, off the charts crazy this year. We thought 2008 was off the charts crazy, but that is peanuts compared to the off the charts crazy we've seen this year. And we have seen gold and silver acting as monetary metals should. I think you could say it's a big change from previous years, and may seem like a big change given how in the doghouse, the metals were for so long. But it really is confirmation of something probably almost everybody in the audience would agree with me about, the nature of monetary metals and how they should behave in a monetary crisis or in a situation where, you have off the charts crazy things being done with monetary and fiscal policy. So I see 2020 not really as changing anything fundamentally, but as really, being almost like a Hosanna call from above for a fundamentalist like me, saying you were right. I mean, look at what's happened. Look at the response to monetary policy. This really tells you that these are monetary metals. Some people sneer, oh, you must be an Austrian if you think about them as monetary metals. They're just commodities like pork bellies or coffee beans. I disagree. I think 2020 has really put paid to any notion that, gold and silver are just like coffee or any other commodity. I mean, yes, they are commodities, but they're also monetary metals, and we saw that this year. So I'm extremely bullish. The money printing, I think, just what's been done already justifies much higher gold and silver prices, and I think we're going to see a lot more ahead. But to quickly bring in the case that you mentioned, I also don't want to be so bullish that, I close my eyes, I believe what I believe, and I'm not going to pay any attention to any data that comes my way that contradicts my cherished theory. So I try to look around, well, how might I be wrong? What could change things? And one thought that has occurred to me was COVID-19 did not cause gold and silver to go as high as they did this year. They were already on an uptrend that, they had bottomed in late 2015, and they had really started a more significant uptrend, upwards after the Powell pivot. Again, monetary policy for monetary metals, that's significant. So late 2018 is what started the most recent sort of hockey stick part of this move. And that was continuing. And that, I think, would have us almost where we are now in gold and silver prices, even without COVID-19 this year. But COVID-19 did happen, right? And Congress did send people a bunch of money that would not have been sent this year if not for COVID-19. The Fed was already lowering rates, but hit the panic in March, And they just fell off a cliff, right? They just went straight to zero, no lowering, no measured reduction, just boom, we're down to zero. That probably wouldn't have happened without COVID-19. It would have taken more time. So the bear case thesis is that some of what was going to be happening over the years ahead was pulled forward into 2020. And, you know, every year is not going to be a 2020. I don't know that we can expect the same kind of extravagance. And, you know, where does the Fed go from here? You know, they don't want to go negative. They're resisting that. Congress can hand out more money, but it's difficult for the Fed to go more negative than they had without really risking systemic instability. So the bear case is that maybe some of the bullishness over the next few years for gold and silver has been pulled forward into 2020, and that could turn into a headwind next year. I'm not predicting this. I'm not saying that's what will happen. I'm saying that's something I want to watch out for.
Thank you, Lobbo. Now we're going to head over to Chris Marcus. Chris Marcus is a former equity options trader on the American and New York stock exchanges. He's a financial writer for Miles Franklin and founder of Arcadia Economics.
With everything happening in 2020, Chris, we've seen, precious metals take off quite a bit. And silver, we saw, double from March and even more than that. But you've kept making the case that really that silver is so undervalued because it's not even at 50% its all-time high. What is your take on where silver has been in 2020 and where do you see it heading next year?
Well, I think this is perhaps the best example yet of people being able to see that what is actually happening in supply and demand for silver does not match this price we see posted on this fantastical thing called the COMEX. And I guess maybe a great way of pointing that out, Andy was on my show a couple weeks ago, and I asked him over the past week how many people have been buying versus selling. Andy, I think you said there were 231 orders and 4 were sells. And this was the same week where you see the price of silver drop $1 on Monday morning on no news that anyone on planet Earth that I've been able to find is able to identify. So I would say 2020 maybe perhaps pointed out more and more to people how this is priced, what's going on, and perhaps also that you can understand what's happening. You don't have to get riled up about it. I mean, if you have a business or a paycheck and you're making income and someone's putting something on sale, then that's good news if you can see it that way. I also get it that people see some insane things happening in the world and want the price to go up. And I think in due time it will. Perhaps one thing that people can take away from the move is that we had silver sit under $20 for 4 years. And then in the span of 4 weeks, it went up from 18 to 29. Now, yes, you had COVID. Yes, you had mines shut down. Yes, you had a surge in demand, all of which support a rise in the price of silver, although those things were happening months before the price actually went up. So while as a student of markets, I love the idea that prices move on news and things are factored in real time, this efficient market hypothesis sounds great. But at least from what I can see, silver is not going to work like that. Yet at the end of the day, you could forget everything that's already happened. If there's one takeaway, I think the Fed has made clear they're going to force the price higher. Maybe it'll be 2021. Maybe it'll be tomorrow. Maybe it'll be 5 years from now. I don't know the answer to that. But I mean, what would happen if the stock market was down 2% tomorrow? Or if something happened overnight? You'd have Jerome Powell in his pajamas running to the printing press. So I just don't see. And then not only don't I see, I've not been able to find anyone, and I'm not just bringing people on my show to agree with me. I can't find anyone on the planet who can explain how the Fed will ever be able to undo the printed money that it's done. You got a taste of that at the end of 2018. I would say with silver and gold, don't expect it to happen linearly yet. For the same reason some people saw the housing crisis in advance, I think this is easy to spot. And and it's nice to be here with everyone tonight because everyone is seeing it in their own way and sharing it. And I get it. Some people don't want to care until it happens, but that's the nature of markets. You say it before it happens and then see where it's headed. So
thanks, Chris. Question for David. David Smith is senior analyst for the Morgan Report and a regular contributor to moneymetals.com. For the past 15 years, he has investigated precious metals mines and exploration sites in Argentina, Chile, Mexico, Bolivia, China, Canada, and the US.
Now, David, I'd love to ask you about, the mines, the silver mines and COVID-19. We saw some shutdowns. How did this pandemic impact the silver supply? And where do you see the silver supply being impacted in the future in 2021?
We were already going into the fourth year of nominal decline in silver production worldwide, with continuing decreasing head grades. And as Andy and Chris and others have really artfully pointed out, and Dunnigan, it seems like often when the price drops, the buying increases. And when the price rises, the buying increases. And I just feel that we're on a knife edge, which is not fully appreciated by the market itself and the participants, that we could have something kind of coming out of nowhere that we look back on it and we go, how did that trigger? Well, it was just that little extra leaf that kind of pushed things over the edge. And we could see silver start ramping up like it went from $18 to $29 through resistance that was supposed to keep it in check for 6 or 8 months. And this next one could take it up to 40, and that's really going to release a firestorm of people wanting to be involved or thinking, I better get going here before this last train leaves me. And I think, I also think that market participants want to find a story that they can really latch onto and participate in. And there are several gold plays and a couple of silver plays that are on the way toward production or toward a discovery of a much larger resource than the market can, sees right now. And any one of those could become a special case, which suddenly sees 300-400%, movement in the share price, and with the concomitant purchase of more metal. So I think it's the old story of things are quiet out there, but maybe a little too quiet. So I don't think we do ourselves a big favor by not paying attention. So we need to be ready to act decisively if we've not added everything we wanted. And if we see something that looks really sharp, to go ahead and try to pick some of that up. So I'm very optimistic. And I think before the end of the year, we could see some fireworks that will really carry into January, February. And I'm pretty excited about it.
Thanks, David. Next up, we have Bill Holter. Bill Holter writes and is partnered with Jim Sinclair at the newly formed Holter-Sinclair Collaboration. Prior, he wrote for Miles Franklin from 2012 to 2015. Bill worked as a retail stockbroker for 23 years, including 12 as a branch manager at A.G. Edwards. He left Wall Street in late 2006 to avoid potential liabilities related to the management of paper assets.
Awesome. Well, Bill, thank you so much for joining us today. What I'd love to ask you about today is the economy. I'd love to transition to the economy because in 2020, we saw, an economic crash because of the pandemic. And one of the things a lot of people are talking about is that, once we have this vaccine, we're going to get back to normal. Now, you've asked the question, were we really in a normal spot before the pandemic hit us? So can you address that?
Yeah, we certainly were not in a normal spot. If you look back to September 16th of 2019, that's when the repo market broke. Interest rates overnight went to 10%, and the Fed was forced to pump 50, 75, 100 billion each and every night into the system to keep that from unraveling. Oddly, the shutdowns with COVID were, if you want to call them, convenient, because that created a massively lesser demand for credit. So that eased the repo stress. It also gave the Fed cover to basically spew trillions and trillions into the system, and along with other central banks all over the world. As far as normal is concerned, you can, I wrote, I don't know, 3 or 4 separate articles and spaced them about 30 days, 60 days apart. And I would title each one, we're only 90 days late, we're only 150 days late, etc. And here comes January 1st, and guess what happens? All of these moratoriums on foreclosures, on evictions, etc., they all run out. So January 1st, you're going to start to see some reality, because landlords, creditors, etc., are going to be able to begin to evict, foreclose, etc. It's almost like, you saw food lines back in the 1930s. You don't see food lines today because of the EBT cards. What I'm getting at is everything has been masqueraded. Everything's been hidden. And what comes now is reality. And the reality is you've got central banks and sovereigns now at 99.7% debt to GDP. That's not the whole system. That's just the central banks and sovereigns. And you go back 20 years ago, and any country that had a total debt of 100% to GDP was entering banana republic. The world is now 267% debt to GDP. The world is a banana republic. So what I'm getting at is what we have coming is a credit event. And of course, because all currencies are credit-based, it's going to be a massive monetary event. And gold and silver are the only monetary assets that they don't have any liability. They can't bankrupt. So while you look back and thought that it was normal, no, it wasn't normal. The central banks had to prop the system up ever since 2008, and here's your crescendo.
Here's your crescendo. I think that's a really good point. And you mentioned all the expanded debt and all the money printing that's been going on. And yeah, I'd love if my father Dunnigan can address this. But first, Kaiser, let's introduce Dunnigan here.
Let's introduce that guy. Dunnigan Kaiser has hosted the Liberty and Finance / Reluctant Preppers channels since 2013, where he brings together leading experts from the fields of precious metals, mining, finance, constitutional liberty, and preparedness to benefit a growing audience of over 45,000 passionate subscribers, 8.5 million views from passionate subscribers.
Now, Dunnigan, can you address this question about all the more money printing we've seen in 2020 and debt creation? It's historic. And what kind of an impact? Why does this even matter?
Yeah, well, I'm certainly no expert on this, but I like to bring experts on my channel, Liberty and Finance. That's what I've been doing all along since 2013, is bring on the experts so I can just ask the questions on the part of our audience, because we're all in that same position of needing to understand what's going on. Why does this feel wrong in our gut, and what in the official numbers that can be available and the unofficial numbers we're not being told can really help us to shine some light on this. So the first thing I was going to share is this chart. Several of these charts are right from the St. Louis Federal Reserve. They have a website called Fred where you can get printouts. And this is the public facing expose of some of the total public debt, some of the money supply, the M1 money supply, and so on. And this first chart goes back to 1965. And it shows both the U.S. federal debt that's acknowledged in the primary debt, as well as the M1 money supply. And you see what everyone's been describing as this hockey stick increase just in the last year. If you go back and look at the 2008 to 2010 period, where the global financial collapse, the GFC as people affectionately call it, or the previous recession that we went through, you can see a marked increase during that period of time, but it looks like a bump in the road compared to what's happening right now. And that's one of the things that occurred to me when Lobbo, when you were talking about, as we've seen often in credit cycles, that's one of the difficulties that is posed by the exuberance or the last phase of a credit cycle expansion is you pull, when you go to these artificially low interest rates, you pull activity forward from future quarters and even future years into the current year, so that everything it masks what's actually going on. You don't realize when people say, oh, well, look at this rise in activity, they think that's a good sign of a healthy economy, but actually it's the sign of a cliff that you're about to go over, and it can cause that big gap to that empty air underneath, that pocket of air underneath future activity. But there's a different way of looking at it, which is the exponential growth function, which from my engineering background is something I'm quite familiar with. And that is that when you're on an exponential growth curve, if that's the underlying fundamental of the system, which does match the fundamentals of a fiat currency system, then you can't necessarily expect to get relief from that runaway phase. In fact, you can't assume that just because this year has been going up faster than ever before, that you're going to get relief next year if the underlying mathematics are that of exponential growth. We have a tweet I'd like to share as well from Sven Henrik, also known as the Northman Trader, who says M1 money supply has increased yet another $210 billion the week between November 23rd and November 30th, on top of the $500 billion in the prior week. That's over $700 billion in 2 weeks. $700 billion in 2 weeks. So the typical growth in the U.S. deficit, the deficit year to year was usually under $1 trillion in recent decades. And so here you had $700 billion in 2 weeks. It says the M1 money supply of the United States has increased by 64.5% since the beginning of 2020. There is no history for this, none. And in the third screen I'd like to share with you all, there's a picture of shows over since the GFC with QE1, QE2, Operation Twist, QE3, global $5 trillion plus in Fed pausing there, but then the Fed caves in. As Chris had mentioned, they tried to take a break and so-called normalize their balance sheet, but weren't able to because the market immediately swooned. So they went into not QE, and now we're in this QE to infinity. And the latest box is around this called mad monetary policy, where it truly appears to be going vertical. So why should this matter? We've had both Rob Kirby and Alistair McLeod on our channel talking about when you hit that vertical section of the exponential growth curve, that the strains on so many aspects of the banking industry and the derivative complex get to be where you simply can't stop. You've really painted yourself into a corner and you can't stop doing that. So if that's the case, as Alistair maintains, then, and several of the guests have mentioned this as well tonight, is that since all of the world's currencies are now fiat currencies, and those are all debt-based, that when you have a runaway in the debt markets and in the bond markets, you're going to get a potential strain and perhaps a fatal strain in the currencies. And people are not used to thinking about this. When you talk to people about what are the financial risks that their family's facing, they think about, well, I don't want to be in risky stocks, or I don't want to be in these or that. This company might get disrupted or whatever. But if the very currency itself of every country in the world is on this collision course with mathematics, we really seem to be potentially entering this runaway phase. We certainly are seeing unprecedented in the history of our country, but not only gross numbers, but percentage-wise numbers increase in both the debt and in the money supply. So that's where I'm trying to sound the alarm system to people who are thinking they'll wait for some sign to be really announced that there's trouble in the banking system or trouble in the currency supply. And that's where Chris Marcus said, you don't have to wait for the official announcement. In fact, we've had Brad Harris on from Full Spectrum Survival saying, the official warning will always come too late. So trying to help people be aware and prepared.
Well, thanks, Dunnigan. Thanks, Dad. Next, Andy, a question for you on all of what Dunnigan's talking about, what all of the rest of the guests are talking about here is, can you outline for us what has changed fundamentally for the economy in 2020?
Well, yeah, like Dunnigan and Chris said before him, first of all, the Fed will never be able to normalize its balance sheet. Richard Russell always said, inflate or die. They've reached a period of time where they've kind of stumbled into a trap. And that trap, when you look at the economy, which has really been in many levels destroyed, you have a Federal Reserve that It continues to require more interventions and stimulus to sustain lower rates of economic growth. And that, to me, is really one of the big differences, is now the acceptance of stimulus as being the white knight to come in and save the economy. And markets react to whether or not we get stimulus. And I think another big fundamental change is the separation between the economy at large, or Main Street, and Wall Street. And, they say that corporate profits are the best indicator of economic growth or economic strength. But, in reality, other than a handful of really very large companies, I would argue corporate profits are really probably pretty bad this year. And so I think, to me, the real big fundamental changes on top of everything that we've seen, 26 or 7% of every dollar in circulation being put into circulation this year alone, the massive money printing and the destruction of the economy through the shutdowns. To me, the real big differences are, number one, the trap that the Fed has put themselves in, where they will have to continue to print money and to stimulate the economy, and two, the major separation, the dichotomy between Wall Street and Main Street, and how it seems to be the tail wagging the dog. Where I come from, I always thought that the stock market was supposed to be a reflection of the economy, not the other way around. So I think, to me, those are the two big differences: an economy that's detached from Wall Street, or vice versa, and a Federal Reserve that has painted themselves into a corner where the minute they stop blowing air into the balloon that has a gaping hole in it, it all comes crashing down. And these are precarious times that I think we have found ourselves in. And quite frankly, as Chris said, and as Dunnigan said, I don't see how the Fed can ever stop. It's inflate or die. I think it's the mantra they will have to adopt.
Andy, did you say that 26% of every dollar has just been added to the economy this year?
That's
essentially?
Correct. That is correct. That is correct. Massive money. And I always like to say, a trillion seconds ago was 31,688 years ago, and they've added over $4 trillion to the deficit this year. These are numbers that have no precedent, that have no way, for us to measure against in terms of historical precedent. And so I think we're deeply adrift in uncharted seas, where I think we've yet to fully understand the implications. And I think we'll see that moving forward.
I'd love to pass this off to Bill, because I know you were talking about the economy, and if you could address what Andy is talking about, how, there's been so much money printing this year. I mean, what kind of impact do you see that having? Do you see us going into high inflation? I mean, some people are talking about how we're going to see essentially like what we saw in the 70s and 80s, like really high inflation. What is your take?
I assure you the 70s and 80s never saw 26% inflation. And that's basically what Andy's saying, is that they've inflated the money supply by 26% in 1 year. In the old days, when reality was around, the real economy would generate cash flow. And companies were able to take debt on, and they could service that debt from the cash flow. And what's happened here is, because the world has basically shut down, the cash flow has definitely lessened. I mean, the cash flow, the corporate earnings are much, much lower than they were last year. I think they got as low as 2014 or 15, something like that. So it was a huge hit. And you got to understand that cash flow is used to pay debt service. And now the debt service interest rates have come down year after year. So the debt service has been smaller. I shouldn't say smaller. The interest rate is lower, but because they keep piling more and more debt on, the debt service doesn't shrink. And the real economy shrinking has really stressed the ability to pay on the debt. And remember, one man's asset is another man's liability. And that's important to understand, that when one person can't pay, the other end is not getting paid. So what it's doing is it's making the debt, the gross debt that has just exploded over the last, well, really over the last 20 years, but since 2008, that exploded debt now is in a much, much more precarious position because the real economy can't service it anymore. So what happened? You had central banks stepping in to pump money supply into the system so that the debt could be serviced. But what happened with that? You've got central banks, like I mentioned, you've got central banks and sovereigns who have basically destroyed their balance sheets. And they are the ones who issue the currency. I personally believe we're going to see deflation of assets and inflation of goods. The deflation of assets will be caused by debt imploding, and the inflation of things we need, daily items, will be caused by the crashing of purchasing power of the currencies. So it's a double whammy. What you own becomes worth less, and what you need becomes worth or costs you more.
Now, I'd love to turn it over to Lobbo, because I know you've talked about things like that, and you've also talked about recently in an article how it'll look like there's a little bit of a rebound in the economy, but that will be deceiving. Could you expand on that?
Sure. So we're going back to the bear case. And sure, why not? Everybody's so bullish here. I'll anoint myself a temporary pseudo bear just so we can have some fun here. I agree with everything everybody has said. There hasn't been a single thing any of these gentlemen have said that I thought was wrong, incorrect, exaggerated, foolish, silly, whatever. But I got to say, I remember being just as persuaded in 2008, 2009. And at that time, we didn't have the madness of 2020. At that time, everything that had been done in the wake of 2008 was off the charts crazy. And the kinds of things that I'm hearing on this call is exactly the same kind of arguments I was hearing back then. Wow, we tripled the money supply. I forget which M it was, but by the time 2010 had rolled around, I think we had tripled the money supply. And it just made perfect sense that gold would just keep zooming. Right? The reality was, the fundamental was, the trend was, and then boom, we hit the brakes at late 2011, and okay, even in 2011, I thought, okay, it's gone a little too far, a little too fast. We should get some correction here, but I didn't think that we'd get a 5-year bear after all those bullish fundamentals. So I just want to say, I am a bull, but I've been a mistaken bull before, and I think it's important to not be so convinced by your own logic and your own reasoning that you stop looking at what's happening around you. And so prices and markets are often driven not by reason, not by the facts, not by fundamentals, but by sentiment and by just craziness piling on craziness. So just imagine, I'm not saying this will happen, but just imagine that a lot of the lockdowns, shutdowns, and everything terrible that's happened this year has all kinds of people putting off purchases and vacations and all kinds of things they're not doing because they're afraid or because they can't, maybe some because they're broke, or maybe not. I've got a son who's making so much money, more money now on unemployment than he was in an entry-level job before COVID-19. He's doing better. He doesn't need any help. He's got a windfall. It's just amazing to me. That's the economy we're in. So, but imagine 2021. Woohoo! Vaccine 27 is even better than vaccine 26. COVID's dead. The witch is dead. It's party time. Okay, we're going to Hawaii. Okay, we're taking trips. Okay, we're buying more houses. We're buying another car. We're doing all this stuff that we put off for all of 2020. So you could not only have the pulling forward of stimulus and monetary policy I was talking about before, you could have this appearance of a booming economy from really just a few quarters of irrational exuberance being pushed off into the future, into 2021. And so then imagine you're the policymakers. And look, woohoo, as travel is back, airlines are back. They don't need any more bailouts. Oh, look, the auto industry is just booming. It's great. Oh, look, housing is great. All these people moving out of the cities, buying houses. And oh, look at this. People are spending. They're buying flat screen. Oh, look at this. The movie theaters are full again. Everybody's happy, happy, joy, joy again. So imagine this big boom in mid-2020. Spring arrives. COVID's dead. Woohoo. I could imagine the policymakers saying, we fixed it. Our job's done. Maybe we could start raising rates. Or we could thinking about raising rates. What a drastic change that would be. And the policymakers in Congress, we don't need any more fiscal stimulus. The airlines are fine now. Everybody's flying again. So there's your bear case. That wouldn't be reality. I'm not disagreeing with anything anybody said. I'm saying this sort of suppressed demand has a spring effect, and it creates this illusion of prosperity. And not just, we've got a recovery, but, it's better than ever, right? Just this massive illusion of prosperity. So you put the brakes on the fiscal and monetary policy, and monetary metals could respond negatively to that. I mean, come on. We've seen this just in the last couple of weeks. Congress says, last ditch, we're going to put together this emergency patch, 900 billion more. Gold and silver go up. And then Congress says, wait a minute, we don't agree. Gold and silver goes down. Okay, so it shouldn't be this way, but our reality right now is that all this nonsense about stimulus, we were talking about how stimulus has replaced the real economy, so right now that matters more than it should. And if next summer everybody's all hunky-dory and we don't need no more stimulus, we don't need no more zero interest rates, that would be a headwind for gold and silver. Again, not predicting this, but I'm not wanting to go into the future blind. Gentlemen, have at it.
I'd love to comment on that if I may.
Sure, Chris.
I agree with everything you said there. I think it's well put. And I suppose it also depends on what someone is targeting. So, to the degree that you could say, all right, well, while we were waiting for gold for 9 years, you could have done other things, made other income. And I don't know, certainly to the degree if someone wants to go trade short term on Wall Street and or do something like that. Yeah, there's a variety of other things. With that said, from 2008, guess that was when gold went from 1,000 down to 700. If we had taken a long nap in between then, here it is, despite all of the things that have happened still. And that's why, to me, having the experience of trading short term on Wall Street, I remember thinking, well, this seems a little silly when you can see something that if you can take that step back and give yourself the long term perspective. I think not only do you have a high, is there a high rate of return possible, but you're in the rare situation where, at least in my mind, on a long enough horizon, there's a high probability of achieving that high rate of return over the longer term. I'm surprised that we're sitting here today with gold, it's crossed above 2,000 and silver still as low as it is. Yet, I guess it depends what people are wanting. If somebody wants a return over the next year, a guaranteed return, I probably wouldn't say go to silver, because you can't guarantee. You accept it is what it is, although when you look at the conditions, to me, it's very similar to what happened leading up to the housing bubble. It's kind of like when the warning engine light goes on. Some people say, all right, well, I'll just hope it goes away. The guy who knows how to look at the engine looks there and sees, okay, there's something here that if it's not addressed, you have a very clear end result, which, for the folks who saw that with the housing bubble, they were right. It probably took longer. And someone was mentioning to me the other day, maybe the metals will end up taking longer than anybody here thinks or could imagine. And I allow for that possibility. But when I look at all the things that have happened and all the different data points that are out there now, if you tell me it goes on another 10 or 20 years, I think that's hard to pull off, but I could believe that more than that everyone that I've spoken to and that's on this call and in the silver and gold community is flat out wrong, and that Dick Cheney's right, deficits don't matter,
No.
Bush knows how to run an economy. And
let me jump in there, Chris, because you've said something really important, and that is when I articulated this case, I have several hats. One is as a private investor, and one is as an evil scum of the earth newsletter writer. And being an honorary evil scum of the earth newsletter writer, I have to worry about how people will react if markets go up or down in the near term. Personally, I don't sweat the daily fluctuations at all, and I'm not really a short-term investor. And certainly in terms of gold and silver themselves, the metals, I basically never sell those unless I have to. So if this thing happens next summer, what does that mean? Does that mean, oh, it's a disaster? It means, hey, great, it's on sale, I'm buying more. So, and I'd like to hear more from Andy on this, actually. Turn it over to Andy. But I just want to say this time frame thing is really, really crucial, right? And if you're looking for, hockey stick gains within, the next year or so, which is what the typical newsletter writer wants. It's how I imagine most of my clients, want me to guide them. And if I say, hey, here's an investment, I have no idea when it's going to work out, but in the next 5 years, I think sometime it's going to be great. I think I'll be able to count my readers on one hand and have fingers left over. Whereas if I say, okay, I think this has a good chance of doubling over the next year, people are like, sign me up, I want to know more. So time frame is crucial. And we're talking about big issues here. And on the big issues, I think there basically is no bear case. There's so much money printing has been done, is being done, will be done. We're all on the same page. But wearing my evil scum of the earth newsletter writer hat, I have to say, it would be horrifically, I would feel bad if I told clients and prospective clients, hey, jump into gold now, it's going to be great. And then it goes down 30% like it did in 2008. That would be unhappy outcomes. So actually, this ties into Andy. And for me, Andy, you're over there. So I'm looking at you, Andy, and say, can you tell us more about the actual real world demand you're seeing from people who are actually buying the stuff and not just pushing paper around in New York? I'm really interested in what your experience is, post 2000 peak.
Sure. So, 2008 was one of the most interesting experiences I've ever had in this industry. It shaped my thought in many ways. You had gold go from 1,000 to 700 in a period of a week to 10 days, and silver go from 21 to 9. And you don't have to be economists to understand that if something that you bought, investment A and investment B, falls by 65 and 30% respectively, that there's probably not much of any demand for those two items. And, page one of any economics book, freshman level economics, freshman high school economics book, page one is going to be the law of supply and demand. And if you see something falling in price precipitously, you would suspect there's no demand for it. And in fact, probably an overabundance of supply as people are selling. It was a very interesting time. In fact, when that happened, within a week to 10 days of that happening, late July 08, every single mine, or mint rather, across the globe was shut down. The US mint was shut down 8 times in 08. The Canadian and the Austrian mint, were working 3 8-hour shifts a day, 24 hours a day, and we're 12 to 18 weeks back ordered. The Perth mint in Australia shut down that August, took no new business the rest of the year, and the Rand mint in South Africa ran out of product for the first time in their nearly 60-year history. And so what was very interesting is that I was getting phone calls from dealers all around the globe, including across Europe. Fellows in Ireland would call me and say, we can't get any product in our normal supply channels in Switzerland and in Germany. Every major dealer across the United States was sold out of product. We were at the time were a U.S. Mint, still are a U.S. Mint authorized reseller, one of only 27 in the world. And so we had a direct line to the U.S. Mint where we were told we couldn't place any orders. Now, this is as the price was in free fall. And if it weren't for David Smith's partner, David Morgan, the entire industry in the United States would have had nothing to sell the whole second half of 08. I got a phone call from David Morgan, who said to me, hey, Andy, I know some fellows up here in upstate Washington, a company called Pyromet, and they have been in the medical device industry for the last 20, 30 years, and they have a boatload of silver that they've taken from x-ray machines that they have in scrap, and they want to fill a void. And so they started making the ugliest 100-ounce bars you've ever seen. They just said 100 ounces. They didn't say AG or anything. No, 100 ounces of what? But I will tell you that every dealer in the country, that's all they sold for a few months. And now think about this for a moment. As the prices are falling precipitously, 65% and 35%, you would think that that means supply is just being dumped all over the place. But in reality, every single mint, refiner, dealer was out of product. There was nothing you could buy. And I honestly believed we were going out of business. And it was at that point that I realized that this was a paper-driven phenomenon, a drive-by shooting, a massive drive-by shooting of the COMEX market. And of course, we all know what happened over the next 3 years. It rallied on its way back up. But I will tell you this, whenever we see these big drops in the price of gold and silver over the last several years, with the exception of 2017, which I'll talk about in a moment, but every other single time, it is completely detached from what's happening in the industry. No one's selling. Nobody's selling as the price is being driven down. In 2017, it was a little bit different. I wanted to hide under my desk or really not even come to the office because in 17, when the price was falling, it came in conjunction with Bitcoin going to the moon. And everyone thought at the same time that Bitcoin and gold were cut from the same cloth. And how could this be? And how could it be that this decentralized new deal that is like gold 2.0, as some people are calling it now, would go up and gold would go down? And quite frankly, it was a dark time in the precious metals industry. But here again, I will tell you, with the exception of 2017, the last several years, every single time we see a price drop, and in 2008 especially, whenever we see a price drop, it is in conjunction with increased demand on physical. And it's because people listen to you, Lobbo, and to Chris, and to Dunnigan, and to Bill, and to David, and people are beginning to realize that there is manipulation, that the only way to successfully accumulate market, product, if you believe it's in a bull market, is to buy the dips and to not chase the rallies. And that's what we're seeing right now. But in general, Lobo, the main difference above all else from what we would think would be the outcome of a falling price is that it's detached from reality in terms of physical selling. Nobody sells anything these days. And so I would argue that it's 100% a paper-driven phenomenon, and that has very little, if anything, to do with physical demand. And you can listen to some of the people that Chris has had on his show recently, Andrew McGuire, namely, who says, you can't find 1,000-ounce bars, you can't find kilo bars, I've heard. And so the big industrial size bars are becoming harder and harder and harder to get as the price has really kind of languish. Now, languish is kind of an interesting thought when you look at gold and silver, which have both done very well this year based upon all traditional measurements, and continue to do well, but they're not moonshotting the way a lot of people thought that they would. And anytime we see a price pullback along with narrative that would support the end of the bull market, it has very little, if anything, to do with people who understand what's going on. Maybe what it does is it keeps other people from jumping into the gold market, selling dollars and buying precious metals. But in terms of people that we talk to every day, it has very little, if any bearing in terms of demand. And quite frankly, I would argue our business is stronger when the price falls. So interesting in that it works that way, but it has, other than 2017, as long back as I can remember.
Well, and supportive to what Andy is saying, I don't see any let up in the demand in the Shanghai Gold Exchange and Silver Exchange. They continue to add every week. And, India continues to add, to buy more silver. I've seen figures that 75% of the available above ground silver has been spoken for by ETFs, which have, had record builds over the last couple of years. And it wouldn't take very much to create a situation like having Bitcoin where that 25% disappears all of a sudden or gets down to the point where it's 5 or 10%. And so there's so many outliers there with the continued dysregulation going on by COVID, which there's talk now that they're shutting down big chunks of the UK and Germany again. They're using a blunt instrument to deal with all this stuff. And I also think, what Bill had said earlier about the increase in the money supply, what happens if we get a spike in velocity, which is what really takes the turnover of money? That's what it takes to create inflation beyond the increase in the money supply. And I think that could happen as necessity, not just because buying food that's become more scarce and more expensive, buying, building materials and all this kind of stuff. So you have an inflation spike due to that. There's so many unknowns out there, any one of which could tip the apple cart over, that I think it behooves people to be aware of the different alternative scenarios that Lobbo and others have mentioned, but not to get to the point where they are so concerned about what might happen, which one of those 4 or 5 could happen, that they don't do anything. And I think it's a wise course to continue to acquire the metal and the quality miners when you see prices go into an area that you feel is justified based upon your planning and the due diligence that you've done, rather than waiting for some magic moment when it becomes clear that, oh, yes, I should react. And we're getting more questions about, should I wait until the chart has 3 closes above 1850 on gold? And should I wait until the tax selling season is done in December? And meanwhile, you're seeing some of these miners up 30 to 70% in the last 4 or 5 weeks due to their own metrics. The heck with the selling of the tax season, or waiting for the chart to give us the answers, because Mr. Market gives us the reasons later. Or look what's happened to uranium. For it's been on fire here the last week or so. So all of these elements, and even now some of the base metals, they share a certain signature for different reasons, but in terms of a concept, there's not a lot of them around to make up for a big problem being addressed effectively by the market without some disruption in the price, often to the upside, whether it's copper, silver, gold, uranium, nickel. More and more of those metals are falling in line with, and of course, if you listen to Robert Friedland lately, with his take on copper, I mean, the EV revolution is not going to get sidetracked no matter what. And whether it's a good thing or not, or whether it's going to be greener for everybody, it's going to demand massive amounts of metals. And to think that the base metals are 5 years out before they start a run after gold and silver, I think is going to leave some people behind, because copper's already knocking, as you know, at multiple year highs. So there's enough unknowns out there that I think it behooves people to try to have a regular acquisition program based upon their goals, the money they have to commit and whatnot, so that they are well positioned, not over positioned, but also not standing there waiting for some magic moment to do something.
And that's a really good point, David. Kind of pointing out that there are so many unknowns right now that just kind of maybe dipping your toe in right now would be a good idea. But obviously everyone has to do their own research. But I'd love to end with Dunnigan here, because that's something you've pointed out so often, that it's better to be many, many years too early than just a couple seconds too late.
The only thing that comes to mind about that is that the strangeness of human psychology. I know Andy's talked about it. We've had others on talking about it, but there's this narrative-driven psychology. Rick Rule's talked about that. I think Lobbo's mentioned that. There's this idea that people are wanting to know, based on what happened yesterday, I can predict what's going to happen tomorrow, and so if I want to be on that. But that idea that you have to be in position, because by the time it becomes obvious that movement is going to happen, or is happening, or already has happened, then you don't get to go back and restart and get the train back into the station so you can get on it again. So by the time it becomes obvious that it was a good idea, it's no longer as good of an idea as it was back when it seemed like it was a bad idea. So that's what we try to remind people. You've talked to me about that for years, Elijah, as normalcy bias, that we are all subject to that fallacy that is, it's always been this way. I'm accustomed to things being more or less this way. Therefore, I expect tomorrow and the day after and the day after to be that way. And when you have these unprecedented things occurring, we're all reluctant to accept the fact that these are in fact very different departures from what happened yesterday or last year or a decade before, and to accommodate ourselves to the fact that if we want to just be ready in some way for that potential eventuality, we've got to make those preparedness times. In other words, you've always got to be like Noah before the flood. You've always got to be out of step with your peers to make those preparations and to make sure that you're ready just in case. Have a plan B, have an insurance. Bill, were you trying to chime in on that?
I was just going to say the time to prepare is when you have the capital to prepare. In other words, the time to buy gold and silver is when you have the capital to buy it. Gold and silver, you shouldn't think of them as a speculation. You should think of them as savings. And knowing what we know with the situation as far as debt has gone exponential, debt cannot be paid back. It can either be inflated away or liquidated, one or the other. There's no way that the real economies are going to be able to pay the debt back. So if you know what the ending is, you're saving for the ending. You're not speculating for the ending.
Definitely. Well, thank you so much, everyone, for joining us today. I guess to end, how was everyone's drink? I know mine was definitely golden, right? It was quite good. It was a very mild beer, but I loved it. So
Cheers.
Cheers to you all. Thank you for coming on. And I'd like to just to end one last point, and I think Bill said it best. And gold is not an investment, and people looking to get rich should look elsewhere. Look to mining shares, or look to cryptocurrencies, or look to other things. Precious metals has been wealth for over 5,000 years, and that's the way I've always looked at it. I've been accumulating it every 2 weeks for over 30 years, never to get wealthy, just as a way to save wealth, hopefully that I never need to use. If I do, I'm darn glad I have it. If not, I pass it on to my kids. And I think that's the most important way to look at your gold and silver. And as we've been saying lately, a common theme, it's not about return on your money, it's about return of your money. And these days that may be more and more and more relevant than ever before. I want to thank everyone for coming, and in particular, David Smith, Lobbo, and Bill for hopping on this time as first-time guests. We certainly appreciate it. You've added a lot to the discussion. And of course, Chris and Dunnigan and Kaiser and Elijah, thank you for spending your evening chatting with us. I hope to see you all real soon. You all take care of yourselves, and happy holidays. Very, very much appreciate your time and your input.
All right. Well, cheers, everyone. Thanks for joining us. Merry Christmas, happy holidays, and God bless.
So thanks again for watching. If you do have any product questions or would like pricing or information, that's Arcadia at Miles Franklin. And with that said, I will see you again tomorrow.